All right, let's jump right in. Today, we're tackling a big one, an accounting standard that is absolutely crucial for your exams and your career. IAS 37, covering provisions, contingent liabilities, and contingent assets. Let's get started. Welcome to ICAN Intelligence. Now, our goal here is a bit different. We're not about just cramming rules for an exam. We're here to build a deep, solid, lasting understanding of why the standard works the way it does. So when you see it in the real world, it'll just click. Okay, here's our game plan for today. We've broken this down into 6 clear sections. We'll start with the why, the core problem. Then we'll dive into the rules for recognition and measurement, look at some tricky applications, and finish up with a solid gold master plan for any exam question. All right, section 1. Look, before we get into the nitty-gritty rules, the how, we have got to understand the why. What is the fundamental headache in accounting that led to IAS 37 even being created in the first place? So, picture this. It's a classic situation, right? A lawsuit gets slapped on your company. You might have to pay out millions, or you might win and pay nothing at all. It's completely up in the air. So what do you do as an accountant? Do you book a massive liability? Do you just ignore it and hope for the best? This uncertainty is the core problem. And that right there is exactly why IAS 37 exists. Its whole purpose is to bring some order to the chaos of uncertainty. It gives every company the same set of rules telling them when to recognize something, how to put a number on it, and what they have to tell people about it in the financial statements. Okay, now we're getting to the absolute heart of the standard. Seriously, if you nailed this next part, you have basically conquered 80% of IAS 37. This is all about the 3 critical tests you must apply to recognize a provision. This is non-negotiable, must-know stuff for your exam. So here they are, the 3 big questions you have to ask. And remember, you need a yes for all 3 to create a provision. 1. Is there a present obligation that came from a past event? 2. Is it probable that you're going to have to pay out some cash? And 3. Can you make a reliable estimate of how much? Let's unpack each one. Let's tackle that first one, a present obligation. Now, this isn't about something you might have to do down the road. It's a real, unavoidable duty you have right now at your reporting date. The magic words are no realistic alternative. You're essentially trapped, and this obligation can come in 2 flavors. So a legal one, that's the easy part. It's written down in a contract or a law. But the one that trips everyone up, the one examiners love to test, is the constructive obligation. This is a duty that you've created yourself through your own actions and behavior. Let me give you a classic example. Imagine a retail company that has a famous no questions asked return policy. Legally, they might not have to offer it, but because they've built this reputation, this valid expectation, they are basically trapped. They have to honor it, because not doing so would destroy their reputation. That is a constructive obligation. All right, test number 2. Is the outflow probable? Now, IAS 37 is super specific here. Probable means more likely than not. You can literally think of it as a greater than 50% chance. It's not maybe, it's not definitely, it's just over 50%. That threshold is a key detail you have to remember. And finally, the third hurdle, can you make a reliable estimate? Look, accounting is all about making smart estimates, and the standard is pretty clear that it's almost always possible. So here's a big exam tip. Unless the question screams at you that an estimate is impossible, you should always assume you can make one. Okay, so we need 3 yeses to get a provision. But what happens if you get a no somewhere along the line? This is where things can get a little fuzzy for people. And it's where contingent liabilities and contingent assets enter the picture. And this slide lays out the difference perfectly. A provision, that's a real liability. It goes right onto your balance sheet. A contingent liability, on the other hand, fails one of our tests. Maybe it's only a possible obligation, not a present one. Or maybe the outflow is possible, but not probable. Here's the bottom line. Provisions get recognized, contingent liabilities only get disclosed in the notes. Now let's flip it around. We also have contingent assets. This is a possible future economic benefit. So going back to that lawsuit, if you're the one doing the suing, that potential payout is a contingent asset for you. Its existence is still uncertain. And listen up, because this is a critical rule and a classic exam trap. You never, ever recognize a contingent asset, period. Why? Think about it. It's all about prudence. You don't want to book income that you might never actually receive. So the rule is simple. You only disclose its existence in the notes, and only if that cash inflow is looking probable. Okay, great. We've gone through our tests, and we've decided we need a provision. So what's the next logical question? Exactly. How much? How do we actually put a number on this thing? This is all about measurement. The standard calls for the best estimate. And really, it's just a common sense idea. Imagine you had to pay someone right now to take this problem off your hands. What would that fair, rational amount be? That's your best estimate. It's not the worst case scenario, and it's not the best case. It's just a balanced professional judgment. But that's fine for a single lawsuit, right? But what about something like product warranties? You've sold millions of items. How on earth do you estimate the cost for all of those potential claims? Well, for big groups of items like that, we use a nifty technique called the expected value method. Just look at the example here. We take every possible outcome, no defects, minor defects, major defects, and we weight each one by its probability. So you multiply the cost of repairs by the chance of it happening for each level, and then you just add it all up. That final €400,000 figure is our best statistical estimate for the total provision. Okay, one last super important measurement point. What if you don't have to pay this money out for, say, 5 or 10 years? Well, money today is worth more than money in the future, right? That's the time value of money. So if that effect is significant, you have to discount the future payment back to its present value. This is a huge area for picking up calculation marks in the exam, so don't forget it. All right, let's put all this theory into practice and look at two specific tricky areas that examiners absolutely love: onerous contracts and restructuring provisions. First up, an onerous contract. The name sounds complicated, but the idea is simple. It's a contract you're stuck in that is guaranteed to lose you money. The costs you can't avoid are simply higher than any benefits you'll get back. As soon as you know this, bam, you have to recognize a provision for that unavoidable loss. Next up, restructuring. Companies talk about restructuring all the time, but you can't just create a provision because management decided to make some changes. The rules are incredibly strict. You need a detailed, formal plan, and this is the killer point, you have to have actually started it or announced its main features to the people affected. That's what creates the constructive obligation. And finally, after you've recognized and measured everything, you have to communicate it. You have to tell the story in the notes to the financial statements. You need to show how the provision amount has changed over the year, explain what it's for, and point out any big uncertainties. It's all about transparency. Whew, okay, we have covered a ton of ground, so let's wrap it all up. Let's build a rock-solid master plan, a strategy you can use to attack any IAS 37 question the exam throws at you. This is it, your 4-step battle plan. Step 1, find the past event that started it all. Step 2, run it through our 3 recognition tests: present obligation, probable outflow, reliable estimate. Step 3, if it's not a provision, figure out if it's a contingent liability or asset and what to disclose. And finally, step 4, if it is a provision, calculate that best estimate. Follow these steps every single time and you'll be golden. So I want to leave you with a final challenge. After this is over, take a minute and try to answer this question out loud to yourself. If you can clearly explain the difference between a provision and a contingent liability and what to do with each in your own words, you've got this. You truly understand IAS 37. All right, that's a wrap on our IAS 37 masterclass. I really hope you found it helpful. If you did, do us a favor and subscribe to ICAN Intelligence. And definitely drop a comment below and let us know which IAS you want us to break down next. Thanks for tuning in.